not doing it in a vacuum and believing that we're going to test the intervention levels in the end. I've been saying that for a few weeks. Maybe this is a week, and then I'll take a look at where everything else is at and see what the setups are there.
Yeah.
So anything happen over there besides you know, the
No,
usual?
yeah, we've got a few things coming up. We've got 12th and 13th. We got the G20 finance ministers and central banks meeting this week. FX is obviously going to be the hot topic potentially for us. We've got PBOC rate decision on their MLF, their medium lending facilities. That's sometime this week as well. It's not pre-announced. I think it might be the 13th though.
So I know it's an IMF meeting. Who's there? Like all the Gs are there? G20, they're all there?
Yeah, or G19 because Putin's not allowed. Don't know if he's allowed in or not.
Okay.
When he turns up, if there's no nameplate on the door, he's going down the pub.
Yeah. It's going to be interesting, especially if the dollar remains under pressure this week, to see if they come up with some type of statement.
Yeah, that's going to be the thing to watch. Yeah, and then we got China starting Saturday is their National Congress, the 5-year meeting thing. So lots of possible comments to come out of that. So lots of left field areas where we can get comments and things from that could move markets this week.
Are you surprised after Friday's close in the S&P that we're not sharply lower today? I am.
To be honest with you, I'm still getting back into it. I was at the bottom of a glass on Friday, so
okay.
I don't know where it went, but from what I make out and what Kay's told me and the other guys in the room, you know, we've had the typical boat running extreme. You know, everyone looking for the Fed to mark a top in rates and everything, and then the NFP comes along and everything's solid, good report, and you know the market's like, well, the Fed are going to keep going. It's exactly as we've been saying it. Until the Fed make a change, the market's going to keep testing on bad data and getting a slap on the good data. You know, it's
and we have inflation data this week. We have inflation. That's going to be the key number this week.
That and retail sales on Friday. So yeah, you know, if it's a bad CPI numbers or lower CPI numbers, not necessarily bad, but if CPI is lower and the core drops back as well, because we have been seeing a divergence where the headlines come down but the core's gone up. So if they're both lower, the market's going to go, oh, the Fed are going to stop again, and yields come off and the dollar gets sold. And then we get to the next FOMC and they say, or the next Fed person says, well, one data point isn't going to change our minds, and then it goes the other way again. So we've got this constant swing between bad data, what the Fed says, and for us, that's good volatility to trade.
Yeah. Okay, Kman, how are you today?
Good. Monday morning, Dale. I loved your little song, and I remember the mamas and the papas.
Yeah, I think she actually died from choking on a bone.
Something, yeah, something like that.
Very ironic.
Yeah, you were talking about the yen. Again, I'd like to make the remark that it's not necessarily the level of 145.90 or so that's important. It's the speed at which we get there, and in relation to what other dollar pairs are doing, in my opinion. So I wouldn't hang my hat onto the 145.90 too much.
No.
But yeah, it's the dollar is.
I'm thinking 680 is. I have a number.
Yeah,
up there.
Anywhere between those high 146s and 148, there's a lot of traffic up there. I hear a lot of people make. I mean, seeing similarities with what happened in 1998, but Mrs. Sakakibara was a different person, though. But anyway, yeah, we are getting closer to that level. So there's going to be a lot of talk on Fin Twitter, at least, about that level. No, it's all going like very, very slowly, but no reason to sell dollar yen. I'd say for as long as the Bank of Japan doesn't move, Ministry of Finance will keep a close eye on it. Get a very rapid move, then I think it may be a different story, and we see more interventions. But the fact,
the 10-year had a chance to make new highs, and well, it's not trading today, right?
Well, no, it's not trading today, but as well, I've been saying on the Flow Show that there might have been some reason to go and retest the 4%, but then the report wasn't of the sort of really going, there's a fresh impetus to this, and we're going through 4% on the 10-year. I don't think the report was strong enough. It was just strong enough to, as Ryan says, give a slap to those who were expecting to see a Fed pivot anytime soon. And we have been warned on beforehand. The Fed speakers were all saying that the pivot is not coming soon, and even with one worse report, and the report wasn't worse. So and I think a lot has to do as well. There's a bit of a difference between selling equities, I think, because of higher yields. And you said you're surprised they're not lower. Well, I'm not really surprised. You know what? I'm going to be honest, and
looks like a buy here with stops under the low.
From a risk point of view, if you take away equities from a pure risk point of view, those are actually, that was a good report. So I wouldn't know why equities would actually dump on it. Wouldn't it be, of course, the correlation with yields and stuff? But I think the risk is found in other pairs, such as Mexican peso, Canadian dollar, euro, the Norwegian kroner. I think that's where in the FX sphere, we need to look at risk. EURMXN is about 1% lower than where it was on Friday. EuroCAD, similar. Euro NOK as well. And I think that's where, with the higher oil on the one hand, and then the proximity of to the US for the MEX and the Canadian dollar on the other hand, they're getting like a double push in the back. And I think that's where really the risk pairs are at right now. They're doing better, actually, which is a bit counterintuitive if you would only trade them on the back of equity. So I think risk is decorrelated from one asset to the other right now.
Okay, so does that mean what's actionable?
I think I'm still in the same positions. I'm short EuroCAD, short EURMX, long a little bit of dollars here, but not much. And I'm short those euro crosses, which I still particularly like to go lower. And that's about where I am now. But I'm not going to put on too much stuff because this is my one and only day in the office this week, and I don't know what's going to happen on the on Thursday with CPI. So I'm going to keep stuff close to the chest.
And euro pound, where are you at on that?
I think as what I was saying, that below 87 looks a bit cold. So I think we might find buyers down there, but then you need to exactly where your green line is, right? The horizontal one. We need to break above that 88, 30, 40 zone to really start going again. So there's about 150, 170 points range there now that we need to observe, in my opinion.
Okay. Stel, you
Hello.
around? Hi, buddy. So I don't know if it's that good that gold came back and, it was a breakdown, then it was a false breakdown and a retest. I don't know if it's that good that it got down here again.
It's definitely not good for bulls. It's not. Let's see where the daily close is, but it's definitely not looking good, and it kind of makes sense. After payrolls on Friday, I'm gonna record this message. I'm gonna play this over and over every day until the Fed changes. Nothing has changed in the macro view, so I think selling risk rallies is the way to go. As simple as that, until the Fed tells us otherwise. And once again, we saw on Friday the market trying to kind of hoping that, yes, this is it, and let's position ourselves. Hopefully it's gonna be bad numbers. The Fed's gonna turn. Well, why put yourself through that stress? For me, nothing's changed. Yes, gold. We need to, as I said, we need to see how it closes on a daily, but not looking great at the moment.
I wouldn't be short either, but
Stel equals Stel. Thank you, Bran. Is that Stel from Friends, Joey's agent? Anyway,
so far silver actually looks better, more like a corrective pattern.
Well, they're both going to be moving together, so I wouldn't get bullish on silver either yet. I have a very small long, which is underwater at the moment, but it's more a tracker position. I really want to get very, very long again, but I'm not touching it at the moment.
Okay, I'm a buyer on further weakness into those zones, and to me, gold-silver ratio looks just like a three-wave correction after a smash from the 50% level. So they're really not moving together, or this ratio wouldn't have dropped from 90 to 81. That's a big move. And if this is just a correction, it's saying, well, if you want to be long and the markets are down, that silver will at least hold up better, right? If this continues down?
If this continues down, yes, but I fear that if we do get more selling of equities, of risk in general, I think the ratio is going to go higher again. That's how it usually is, right? Gold falls 1%, silver falls 2%. That's the standard. But yeah, let's wait and see. I'm not hurrying into anything at the moment.
Yeah. Okay. And that what else is there to cover?
It's been pretty quiet today.
What's going on geo-wise and?
Well, it's interesting because there seems to be more and more escalation now in Russia. The bridge that got blown off, then now targets are getting hit in the Ukraine. It's all escalating, and is it escalation to de-escalate? I don't know, but I was expecting markets to trade a lot worse.
Where'd you get that expression?
I can't remember. Somebody said that. De-escalates to de-escalate.
That's Putin's doctrine.
Yeah.
Okay.
It could be the case. But at the moment, things are escalating, and I'm actually amazed that after last Friday's data and the move and the overnight, like the weekend news from Ukraine, and we're not lower. I'm really surprised, but. Hey, what do I know? I'm retail.
What do you think of Curaleaf here?
Curaleaf, what's that? Oh.
Well, what leaf cures? Many. There are many herbs, natural medicines, as Blake will attest to. Someone in his family.
Medicine.
Maybe we should take a little echinacea if we're on the edge of a little cold, Blake.
Well, that chart.
Some golden seal root.
Wait, are you advocating for marijuana right now? Is that what one leaf?
No, have you seen the Willie Nelson commercials? Oh, he says I've been fighting for this to be legalized for a long time, and he's really talking about Skechers, the shoes.
Oh,
kind of funny.
No, I didn't see that.
Yeah, that's pretty good.
I did not see that. Well, good morning, everybody.
Good morning, buddy.
It is kind of. Hey, good morning, Ryan. Welcome back. Happy. I know you were out with your mates celebrating your 50th birthday. So hope you had a
that's
great time.
why you went crazy.
Happy 50th, man.
Yeah.
No, not yet. That was just a football trip.
Oh,
50th.
Oh, well, I thought that's what you were celebrating for.
Yeah, Ryan's always has something to celebrate.
Exactly. Yeah. I'm not that.
Well, welcome back. It's nice to have you back. And I know it's kind of a slow day today with we have bond markets closed. It's Columbus Day. I was just saying that I always miss Columbus Day now because my kids are on fall break. And so when they're on fall break, it's like they're off anyway. So I don't, unless we're going somewhere, and we typically don't go anywhere because this is the time of year where you don't want to go anywhere because the weather's so nice. You want to leave like in the summertime. Yeah. Anyway, so I totally forgot today is, but happy Thanksgiving to those people in Canada. If you're celebrating your Thanksgiving holiday today. As far as the markets go, one thing I do want to point out is the Aussie dollar is at fresh new 2022 lows. I mean, you know, we have this bear flag pattern. I mean, you look at the pair and it just continues to bleed into new lows. Now, Steve had said this last week, excuse me. Steve said at some point this is going to be a great buy. You know, I agree. I always look at the Aussie, and I was right. I like to go to this chart and just remember that, you know, this low following COVID that you see right here, that's 55 cents. That's 800 pips away from where we're currently at. That's a generational low. When I say generational, that means, you know, 20 years or roughly. We shouldn't see that level again. I don't think so. And I think you want to be a buyer on dips down here. Now, I've tried to long-term get into Aussie longs, and it hasn't really worked out for me on a lot of different occasions, but it doesn't mean I still trade in both directions though. But I do believe that the Aussie dollar is a currency you want to own a little bit longer term. But, you know, today you look at it and it's like, damn, that's it's new, fresh 52-week lows. So we have to take that into account. But Kman brought up a point that we were talking about in the ForexAnalytix chat room. If you guys are, you know, you guys want to see even on a day like today when things are really slow, you know, we're out there talking and discussing the markets. You know, this is just in the last hour, you know, like right here. We were just talking about the dollar Mexican peso, which it is trading heavy. And as Kman pointed out, the euro Mexican peso is down 1%, and we're at fresh new lows. Now, I know I made a big stink about it on the week ahead video, talking about the Mexican peso and how much how bullish I am. But this is a really unique situation. As risk has been heavy, you have the dollar Mexican peso that's been heavy, and you know, all we need really is the S&P to trade back to 4,000, and the dollar Mexican peso will be probably at these lows, if not, you know, fresh new lows. And I'm very much a dollar Mexican peso bear, and you know, that's how I'm trading it. But Kman, do you want to explain to traders a little bit? And I know you're very, you know, bullish to Mexican peso as well. Do you want to explain to everybody the carry beneficiary of the peso and how that works?
Yeah, I mean, well, it's relatively simple. It's a differential in interest rates. And when you're long peso versus a currency that has a lower interest rate, you're getting paid to be long peso. It all depends how much your broker is ripping you off on the swap points. But basically, you're getting money for being long Mexican peso. But of course, you need to do it for the right reasons. It's not because you're long an emerging market currency. We only have to look at the rand, for instance, or the Chinese yuan, if we can still put it in there, to know that it's not always just about grabbing interest rate differentials and swap points.
Sure.
But the peso, as I've been already mentioning a lot of times now, has this advantage of being far from the Ukraine action on one side, proximity to the US, because Mexico is one of US's manufacturers as well, and it's going, like, the dollar is big, so Mexico and to a lesser extent Canadian dollar are benefiting from that as well, and you have high interest rates. So the combination of those three things or four things are still telling me that Mexican peso should be less impacted and doing better than other emerging market currencies.
Yeah, and you know, I know I'm a little biased just because I live, you know, next to Mexico in Arizona, where we're just, you know, obviously they're our southern border. But I happen to, you know, a lot of people I talk to that are small business owners, they do a lot of business in Mexico. And you know, my best friend's over in, one of my best friends is over in San Diego, and was the EO Entrepreneurs Organization, you know, chapter president there. So he knows all of these small business owners. So every time I, you know, talk to him, I'm talking about him about, you know, his friends in Mexico and the manufacturing they're doing out there. And there's just been a lot of American businesses that have brought business back to North America from China from a manufacturing standpoint. And I think Mexico is just going to be a longer term beneficiary. So there's so many different reasons that I think the Mexican peso will outperform. But and also whenever you get in a good risk environment, that carry that Kman was just mentioning, it's not necessarily the reason you want to be buying it. It is just a nice kicker for when you do buy the Mexican peso. Anyway, enough about that. Thank you, Kman, for spending a little time on that. I'm going to show you guys also gold. Dale, you said you're long, you're bullish silver, which we can talk about here in a second, but gold actually came right back down to that 1680 massive support. It's a 50% rate retracement right here at 1673 on the cash market. But take a look, if you look at the daily chart, these are those spike lows back at 1680. We're back there again. What do you guys think here? I mean, I shouldn't ask Stelios because he's just going to say I'm bullish. But Dale,
we talked about it earlier. I didn't say that.
Oh, you did? Okay, I'm sorry, I missed it. I missed that conversation. But what do you think? Here we have the gold back at 1680. I know, Dale, you can talk a little bit about silver for in a second. But what do you think about gold here?
Well, as I said before, I think given the macro environment, given what Friday's numbers were like, and given the escalation in Ukraine, theoretically, on a really big, dangerous geopolitical event, let's say, gold usually gets bid. But the way things are going with yields and central banks, it still looks vulnerable. We are at the point basically where it has to make a decision. If you want to go long here, could do that, but you have to have very, very tight stops, because if this area, like 1680-ish, goes on a daily close, I think we're going to go and test back the lows at 1615, wherever that was. So risk reward long here, probably not a bad idea, although I do think the probabilities are in favor of going lower from here. So I'm not I don't have conviction either way at the moment. I'm watching the price action.
All right, so Dale, why are you getting long silver down here? What's attracting to you about silver? I'm looking at it. I'm not really like I don't. Once we broke through 20, I guess it would make me a little nervous. But what are you thinking here?
Last week I was talking about 1950, maybe $19. I'm going to try it at 61.8. Still think the gold silver ratio favors it, and I'm expecting something out of the G19 this week to talk about, at least try and jawbone about the dollar. It's almost a perfect setup if the yen is taking out previous intervention levels and the dollar is acting strong in this week, for them to come in and try and jawbone the dollar lower. So I like them both. I just think it's more of a probably a buy at gold down there at 1760 and silver there at your but I think this is for people that thought they missed the rally and went, oh shit, I missed it, and now they're going, oh, I guess I didn't miss much. I think this is an important pullback to buy.
All right, well, so we probably shook out all the people that were like, oh, I'll just be long while it's above 20. Yeah, those traders got stopped out. Maybe that was enough. Then we test the 50% retracement. Maybe that's enough just to get everybody out.
If we put in another low, unlike gold, which would be making its second higher low, silver will be making its third higher low.
Right. Yeah. Well, that's true. Yeah, that is true. I know bond markets are closed today here in the US. But if you look at,
they're glad. The people that own bonds are glad when the market is closed.
Oh my gosh, you talk about the
it's a good day
traditional like portfolios. It's like what a ass beating. But you got bonds that are down, or boons, that are down. Gilts are sliding again. That's scary.
Yes.
Hey, what's happening in the UK? Was there some like headlines from the UK this morning that I missed? Kman, Ryan,
just that Chancellor Kwarteng is bringing out his fiscal plan on the 31st of October.
Well, obviously the market's just selling gilts again. So what do you? I mean, what do you make of all that?
Is he doing that on Halloween intentionally? Oh, you guys don't celebrate it Halloween, do you?
Yeah, we do.
Of course they do.
Oh, yeah. Okay.
There's paganism all over the place, Dale. For Christ's sake,
it's the only day Stel can. It's the only day Steve can go out on the street and people don't say take it off.
Nice.
You guys do know that Steve and his family are coming to my house in the United States. Here he's flying in. When are you flying in, Steve? Right after our event, and he's specifically coming so his son can go trick or treating.
Exactly. Imitate Steve saying the trick or treat.
Yeah, his son. Yeah, we believe that.
Yeah, we're going to be in Arizona, Blake, around 9:30 at night.
What's your costume this year,
Monday
Steve?
the 24th.
What are you going as? A trader?
As the Naked King. You know the story, right?
That's you are not going to be riding in my car. Let's and by the way, Steve is coming to the United States right after this event. If you guys haven't registered for this Trader Summit event, make sure you do so. I know most of you have, but you guys know you can also win one of 2 iPhone 14s. They're our sponsors, 8cap, are giving 2 of these, not pink ones. It just, I don't know why that looks pink, but 2 iPhones. So they'll be unlocked. So you guys, and if you register, you're automatically registered to win. So make sure you guys register. So Steve will be coming to the US, but you guys were just talking about the UK and it being Halloween, and going back to the UK news, Ryan, what did you make of it? Because we got really sidetracked there for a second.
I guess it's suitable to try to fight inflation during Halloween by creating more inflation, right, Ryan?
Yeah, exactly. But it's going to be a big thing. Now, it's not till the 31st of October, so there's nothing been announced, okay? But it's going to be big, because you're going to have him coming out initially with how he's basically going to pay for all these tax cuts and all the policies that created all the mess the last couple of weeks. Then you have, after that, you're going to have the OBR, which is the one who passes judgment on whether his plans are achievable and can be paid for, and the market's going to move on that. And then that all comes a few days before the Bank of England meeting on the 3rd of November, where whatever the markets do and the OBR does may set the tone for what the Bank of England does. So it's all coordinated stuff, but not until the end of October. So we've got a bit of time yet, but that's what we've got coming. It's going to be big.
Remember, the November meeting is the inflation report meeting as well. So that's always more important than the others.
And everything else, yeah.
So Simon was pointing out Britain's Financial Conduct Authority has asked gilts and related markets for daily real-time reporting on any significant deteriorations in market conditions. So, I mean, that was a headline that came out earlier this morning. So
we've had the BOE extending, or they're going to they're going to increase this daily gilt buying until the 14th of October. Instead of it being 5 billion, they're going to do it exponentially larger, just in case there's any further liquidity issues. And they're running some other collateral program just for this pension situation. So they're keeping a tight grip on it, on any liquidity issues. So that should be more market calming than anything else.
Ryan, that is how we call them now, right? Liquidity issues.
As what? Say again?
If it's working, Blake, of course it's going to be working. I mean, they're just stepping in the market and they're practically the only buyer. Of course it's going to work.
Yeah. Obviously it's not working, because I mean, you look at, we're nearing those lows from a couple of weeks ago, but it's interesting.
Trust me, it's working, because if they hadn't stepped in, the prices would currently be at levels we would just be talking about them.
Okay. And you look at the sterling, and the sterling is not really moving, and I wonder if that's a result of investors starting to feel that the Bank of England is going to just have to raise rates more aggressively. It's interesting to me. I'm not trading the sterling here. I don't have anything on as far as the cable goes, but we are not really moving.
I think it's the most bullish looking currency chart that we've gone over today. The give back is kind of right where you say it's strong, Blake, when the market only gives back 38%.
Yeah.
So far with like, you know, Euro's already back to 61.8 fib. So, you know, I think there's higher. I think you have to be a buyer here. And look at how well you showed the gilts, how well it's held up compared to the gilts.
Yeah, you know, I guess, and I know you have an interview coming up, and I just want to say that, you know, as long as the S&P can hold, you know, maybe above 3,600, and you know, we're trying to forge out not a new low in the S&P. Yeah. I think that's worth noting, at least today. Well, you know, today with the bond markets closed, it might have a better shot at not hitting new lows. But there's a lot of work to do, and I think that we're going to know. We're gonna know by, I would say, Thursday morning, since that's when CPI comes out, if we're gonna trade up to 3,900 or 3,500. I think, and unfortunately, that's gonna be the case, right? It's all about higher inflation or weaker inflation. Yeah. Hey guys, I just want to say thank you everybody. Make sure you guys take a look at the trader funding program. You want to learn how to trade our money and not risk your own money. All you have to do is take an assessment. You know, it just check it out, to watch the video at the very top. You know, it's a great way to just not put your own money at risk and trade larger account values. By the way, I was going to have an interview with our biggest payout for a live account. He's going to be this week, but we had to shuffle some things around, so I think it's going to end up being in a couple weeks from now. But don't worry, I'll eventually have this gentleman on, and we're going to do a one-on-one, and he's going to, you know, kind of talk about, you know, the ups and downs of prop trading and how to get through it and those types of things. So check it out. Again, they are our sponsor today, the Trader Funding Program. Dale, I hope you have a wonderful. And by the way, I don't know if you guys saw this, but are the prices still lower? Stelios, those are supposed to change today.
We will later on the day, mate. We will.
All right.
Them.
Hey, then that means today you guys have probably
the last few hours left. Last few hours, and then I thought that would be changed already. By the end of the day, end of business day, this will be $189 a month. Yes,
and that's it. So take advantage of it. All right, Dale.
All yours. Thank you, Blake.
Thanks, guys. Thanks, team.
Bye-bye.
See you guys. Thank you for, you know, not much to talk about on a day like this. We found plenty. Hiya, Jim. Welcome back to F.A.C.E. How are you, buddy?
Hey, good. Can you hear me, Coach?
I could barely hear you. You're in a tunnel. You have a mic on or a headset? Jim, I could barely hear you.
You know what? You might want to have him change his.
Got you now, Jim.
Why am I?
You're good now, Jim.
Okay.
Okay.
Can
you hear me?
Yes.
What are you using? A microphone in your computer today?
Hang on a second.
You're using what?
Sounds like he has a very poor internet connection too, Dale.
Yeah, it does. Okay. Give it a minute. Live TV, man.
Okay, how we doing now?
Better, Jim.
Okay, sorry about that.
That's okay. So, welcome back.
Hey, great to be here.
What's on the radar with, you know, recent action? What do you want to talk to us today about?
Can I steal your screen?
You can steal it. Yes.
Okay. So you got
conundrum. Me? Yeah, we have the conundrum round 2. Okay.
So, you know, the last time I was on, interestingly enough, was at the June low.
Mm-hmm.
And here we are at what may or may not be an October low. So I thought we'd revisit some things that we saw in June and maybe we're seeing again in October. So at the June lows, we had the S&P hitting that low, and the observation was that volatility measured by VIX and some of the other volatility measures just didn't want to do anything, didn't care, was not printing higher highs along with the S&P lower lows.
Right.
Here we are in October, and I've got my little minion, blah, 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 because we're seeing the same thing, right?
Yeah.
We're printing lows, and it just seems like nobody cares. Nobody's panicking. The red line in the middle panel is the ratio of 9-day VIX to 30-day, the standard VIX. And we've seen that that's popped up above 1 a few times, but
converging again with everything.
Yeah, converging again. We're not seeing the kind of spread that we'd like to see in a bull market, but I would argue that we're not in a bull market, so get used to it. Another view, and this is just taking the raw SIBO indices, 9 days, 30 days, 3 months, 6 month. And back in June, what we saw was this, again, convergence, term structure flattening, but really not moving higher. And here we are in October, and we did unclench when we got that rally from the June low into August. But as we've turned around, we're basically squeezing
both sides.
and squeezing all of these things back in the same place. But again, we're not showing any real panic. And there are lots of theories about why that is, that, large investors have just reduced their equity exposure and or done some hedging. But I think it's, reasonable to believe that, any number of people have really just kind of taken exposure off the table. And as a result, don't feel the need to run out and pay up for insurance.
Okay.
Now,
so
this, go ahead.
No, I mean, I talked to someone and I said, do you think that we should be concerned in a month or so about year-end tax loss selling? And his comment was they already did it when they had to liquidate their margin positions.
Yeah, I think you could see some year-end tax selling, of course, for people who have maintained some exposure and maybe want to shift exposure in a tax-efficient way. But I would suspect that it will not exactly be an avalanche at year-end.
We already had it.
Yeah, I think we've already had quite a bit of it.
Yeah.
This one is interesting because it compares where we closed on Friday, again, across using the SIBO indices as a way to look at the volatility term structure, relative to a 12-month look back, which is the green line, right, where it's obviously at a lower level, although still elevated. But at least we've got some of that sort of contango, the lower left, upper right. And then going all the way back to January of 2008, when the SIBO started to print the 6-month VIX, you can see that those longer term averages, are significantly lower. The long-term median for VIX is still under 20. But going back to 2008, we capture the global financial crisis. We capture all of the hiccups, 2011, 2015. We capture COVID. And you can see that the current levels are clearly just dramatically higher than even the 12-month averages and the long-term averages. So even if we're not, quote unquote, spiking into these lows, we're already
still elevated.
We're already at really high levels. A 31 VIX implies roughly 2% moves in the S&P, right? If you take the rule of 16. And so we're we're not steadily getting 2% moves, but even if we were getting 2% moves, which would make people crazy, the VIX is already there. So implied volatility is already saying buckle up and stay buckled up.
Okay. All right. So, this is more of a persistent than aberrational behavior.
It has taken on a persistent nature. And, again, this is just the more traditional way of looking at the futures term structure. And what's interesting here, everybody's wondering why you have the dip in December. We've got an extra long expiration period because of holidays and everything in there. But, this from highest to lowest is less than 2 points in this term structure. If we went back to
compressed,
very compressed. If we went back to sort of normal bull market days, obviously the front end would be much lower, and you'd have at least 5 or 6 points of spread between the front end and the back end. We've got nothing like that. And again, this just says that people who are pricing insurance are pricing it at very elevated levels, and there's really not much of an indication that in the near term anybody wants to have that price come down. And all of this is leading to some interesting consequences. If we look at the year to date, and the red line is the S&P 500. So, you'd think that hedging would have provided some benefit. So these are a couple of ways to look at hedges. One is the SIBO put protection. You buy a 5% out of the money put. And the other is a VIX tail hedge, where you're buying calls on the VIX near the money, 30-day. And as you can see, put protection really hasn't done much of anything for you.
No.
And tail hedge protection really hasn't done anything for you. In fact, you're worse off because of the expense associated with buying those puts or those calls on the VIX. And so, you scratch your head and say, I thought these things were supposed to give me some downside protection. They're clearly not working in this environment. And again, part of that is because it has been a relatively steady grind down, and the cost of these things has been very high. Now let's look at the flip side, because this is where I think some people get surprised at what's been playing out this year. Vol selling strategies. So a SIBO put right. You own the S&P and you write puts against it. Or the buy right, you own the S&P and you write calls against it. Both of those vol selling strategies have actually improved your outcomes year to date. And, I think
it
that's—
didn't matter the direction either.
Yeah, that's a bit of a head scratcher for some people who are thinking, how can I possibly be selling volatility in a bear market? And the answer, at least year to date, has been because what you're selling has significant premium associated with it.
Yeah,
and you're not getting taken out, in the way you might be concerned about. So, this, I think, has been the head scratcher.
This is a new regime, or is it temporary insanity?
That's the question that we're all searching for the answer. We don't have the answer, but I think where people think, okay, bear market, I want to be long volatility. I want to own some puts, or have some VIX calls as insurance. And the reality is that at least
you've lost money being right. Nothing more aggravating than being right and losing money on the idea of being right.
And your audience is pretty sophisticated. You've got a lot of people with significant options expertise out there, and experienced option traders understand that getting the direction right does not always
half
mean you
of it.
win.
Yeah.
Yeah, at
You
most
have
half.
to get the, yeah. You have to
You've
get
got
the
to
time
understand the
window right.
relative. Yeah, you've got to understand the relative value of what you're either buying or selling.
Right. Right.
So
You have to know all that Greek stuff. Theta, beta.
Yeah, all
Huh?
those Greeks.
Okay. So Jim, you know, it's a muddled picture at best. I mean, are you in favor with the S&P hanging on this 3,600 level to sell premium, sell vol in this environment?
Well,
It's hard to do mentally.
It is hard to do mentally, and at the same time, it has been providing some benefit. So, you know, I think if you're going to own equity exposure, you might consider, you know, selling vol against it rather than buying vol against it. But, you know, obviously I can't provide blanket advice to an audience I can't see, but, you know, certainly so far this year, that strategy of selling vol against your equity exposure is probably something that a lot of people didn't see coming, didn't see working.
Because it sounds to be the most high risk strategy that you could possibly put. It's a Texas hedge. So you're long, you're long the cash, and you're long the futures.
Right.
Right. Texas hedge.
There you go.
Side. So you're, you know, actually would be increasing your. People would look at that and say, well, if I'm selling vol, I'm actually increasing my risk.
Right.
Of a market decline. Anyway, very counterintuitive. Are you ready to give up paying attention to the VIX and look for another toy?
Oh no. Oh no.
You love this challenge. It's mental challenge. Such a masochist, Jim.
Well, somebody's got to do it.
All right. So, I mean, do you see what would change this?
Well, let me get to it. Let me get to a couple of things.
Okay.
So here's a picture from, you know, covering 2018, 19, going back to the beginning of 18, just showing, you know, that there's a FANG index, right? And the reason people loved the FANGs was because of this. Unfortunately, this is what's happened year to date. You know, FANGs have significantly underperformed the S&P. They're giving back some of that gain. And, you know, how much of that is fundamentals versus liquidity and technicals? Who knows? But certainly, you know, if you needed to sell equities into this market decline and you had a bunch of FANGs in your portfolio, you might have decided to take some of that profit off the table to give yourself some room to move. And this is one of the things, you know, this really represents a huge chunk of market capitalization. These were leaders in the market for a long time, and they've lost their leadership. You know, so it seems to me that one of the things you might want to see if you're a bull is for this to turn around, at least to a certain extent. You know, has there been rotation in the market into other sectors? Sure. But, you know, again, you can't turn the S&P 500 ship without these large cap tech stocks turning around as well. So this is something, you know, that's worth keeping an eye on. You know, bonds, well, you know, if you shorten up your duration, you know, the ag has a duration of 7-8 years versus 20 plus for TLT. And so obviously you've been punished for holding duration in your bond portfolio.
That's for sure.
But, you know, even with shorter duration, your 60-40 portfolio, those bonds that are meant to be providing protection to your portfolio really haven't done that. And
they've been hand grenades.
They have been hand grenades relative to what anybody thought. So people are opening their, you know, brokerage account statements and seeing everything negative. And, that certainly has hurt investor sentiment. From a volatility standpoint, we do focus a lot on the VIX. What some people don't necessarily recognize is that volatility in the bond markets, has been a lot worse.
Yeah.
The MOVE index is a measure of, bond market volatility. And, this year, volatility in that market has, run away from volatility in the equity market. And, once again, I think we would want to see that reversing course as a sign that things are stabilizing, and it ain't there yet. Couple other things that I pay attention to, as indicators of things either staying bad or getting better. One is just it's a breadth measure, 52-week new highs versus 52-week new lows. Made its low for the year in May. At the June low, we had what chartists would have referred to as a bullish divergence, and we did get a nice run starting in mid-June through August. This most recent activity, at least so far, put a bottom in on September 27th. We'll see if that, holds. It could fall back. The other thing I look at, again, signals from the bond market. This is full credit to Tom McClellan, whose, family gave us the McClellan oscillator and a number of other indicators. He looks at advanced declines in the bond market, in the high yield market specifically. And, this was a great tell at the beginning of the year because high yield bonds had rolled over before the S&P made its high at the end of the year. And, really with a couple of slight reversals, have been going straight down. And, importantly, in this latest activity, they made a new low where, the S&P is bouncing around in the neighborhood of its June low. So this is something else that, I'd like to see turn around as a sign that the bond markets, are healing, which I think, spills over to a certain extent into the equity markets.
If you pull back that MOVE index chart, I see a formation that I can't help it, that I see all the time. It's a pattern, it's a 3 drive to a top formation that you had in prior to April, June, July, and now the most recent one. And I would guess, without having an indicator underneath there's a lot of momentum divergence happening there. And this could end up being a high in the MOVE index.
It could be
close to it. So that's a great chart for me to, kind of, because I tried to buy the bonds about, 3 weeks ago, stopped.
Right.
But I still think there's something coming there. That's a nice look. So
well, the equity markets would hope you're right too.
Yeah. And so we'll see. That would change the game a little bit, right?
Yeah,
you do
I
anything
think so.
with the MOVE index to trade it, or
even
around it?
Even the man who created the MOVE index, a guy named Harley Bassman, would tell you that, it's an interesting statistic. There's nothing tradable around it. But I think, the same way you look at it and say, give me some sign that there's a reversal in this thing. I think you're better off, trading whatever futures or cash markets on the fixed income side. Use this as kind of a weather vane.
Yeah.
Right. Right now the weather looks like periodic hurricanes.
Okay. So if the MOVE index peaks here, Jim, would you think that selling volatility becomes an even more profitable trade? Or
It certainly could be. I think, what it would suggest is that the interest rate environment, is starting to calm down. There's all this talk about whether the Fed's going to pivot or not pivot. If you go back and look at those times in history where the Fed has reversed course on its interest rate path, it's been a good thing for the bond market. It hasn't necessarily been a good thing right away for the equity markets. So
That's true.
Whenever we see the Fed put an end to interest rate rises, you'll probably see this move index reverse pretty hard, and you'll probably see bond prices begin to reverse course and move a lot higher.
And the market may like it for a while, but then comes to the realization, Jim, that rates are moving lower because there might be a growth scare out there.
Historically, equity markets have not rallied at the same time that interest rates have started to ease.
Okay, there's a lag time between the turn in the bond market and the turn in the stock market then.
There has been historically.
Okay, what a great interview. Jim, best way for people to follow your work and your conviction that once a VIX man, always a VIX man? Huh?
The easiest
and I'm
way.
not talking VIX Vapor Rub, guys. I know I need it during flu season, but Jim's with the VIX, so
the easiest way to follow me is on Twitter at Vixologist.
Yeah, thank you, Jim.
I'm present there on a regular basis.
At Turoso? You
don't have anything published.
Okay.
Through Turoso at this time.
Okay.
We're working on some ideas, but follow me on Twitter and you'll get more than you probably want.
Yeah, you want to learn about this stuff. Jim is actually a great ambassador for this product that's starting to lose favor because it's not behaving like it has historically, but that makes it even more interesting. And we need guys like Jim to explain it to us, because I know I would have been very disappointed playing the VIX during this bear market in 2022. And Jim has said in previous interviews why it's not the same game anymore. So thanks for being a watchman for us, Jim.
You're very welcome, Dale.
Really appreciate you filling us in, and because most of us, including me, it's pretty esoteric, and you dig in. So thanks for the clarity.
You're very welcome, Coach, and I look forward to coming back at some point in the future.
Okay, we'll do that. I'll drop you a date, and everyone thank Jim Carroll, and there you go, nice crowd. And they're thanking you, Jim. And you could join the team in 15 minutes on the Morning Edge. Remember, don't just count your VIX, count your blessings. And we'll see everyone for Turnaround Tuesday when the market's at full force tomorrow. Thank you, my trading warrior brother, Jim.
Thank you.
See you, buddy. Bye, everyone.